Okay, welcome back. Ryan Miller Trading Economics. Today we're going to talk about interest rates. As we know, they've been on the rise and been showing no signs of a top. What we're going to talk about is how can we use interest rates to determine the turning points in the economy and thus in risk assets. Now, many, including myself, have referred to interest rates as a leading indicator. Now, interest rates are actually a lagging indicator. Right? So what we're going to talk about is how can a lagging indicator lead. That's what we're going to get into. And to do that, we are going to head to Mr. Jeffrey Moore, who is like the father of leading indicators. He wrote a book in 1983 called Business Cycles, Inflation, and Forecasting. And in chapter 21, called Why the Leading Indicators Really Do Lead, he wrote, still, another type of indicator is described as lagging because their fluctuations usually follow those of the coincident indicators. Remember, coincident is determines the trend, where we are right now. We've talked about this before: employment, consumption, production, income. Examples are labor costs per unit of output, the level of inventories, and interest rates on mortgage loans. That's what we're going to focus on today. They are not mere followers, however. Cost factors, as we note below, have significant implications for the subsequent performance of the leading indicators. Many of the indicators classified in this group can, in economic terms, be described as measures of excesses and imbalances. So he's saying that interest rates are a lagging indicator and they can expose excesses and imbalances in the economy. And that kind of makes sense, right? So think of home prices, right? If there's a lot of demand for homes, right? There's mortgages are increasing, right? People are trying to buy homes, then interest rates are going to follow, right? The more demand there is for housing, interest rates are going to move up. And same on the other side. If demand falls in housing, right, interest rates are going to follow. So interest rates lag economic activity. If we take a look here at GDP and the 30-year mortgage rate, so GDP is in red, and the 30-year mortgage is in blue, we can see that happening, right? So right here in the red, we have GDP peaking, and then shortly after, mortgage rates peak. And here we have a bottom in GDP and growth, and then a bottom in interest rates. Interest rates are lagging economic activity. Then we have a peak in growth, and then followed by a peak in interest rates, right? Interest rates are lagging economic activity. Fast forward to today, we can see that happening here. We had this big move up in growth, right? It bottomed, and then shortly after, interest rates followed, right? Lagging behind economic activity, okay? Now, in that same book, in chapter 23, when lagging indicators lead, the history of an idea, Jeffrey Moore says a downturn in a leading indicator, say an index of stock prices, is not the beginning. It is a result of something else. The something else is where the lagging indicators come in. So let's think of interest rates, right? As interest rates say turn up, right, that's going to put pressure on the system, right? It's going to increase borrowing costs, right? It's going to increase debt repayments, right? It's going to reduce profit margins in the future. So what's going to happen is after interest rates turn up, we're going to see leading economic indicators start to roll over, start to turn down to price in what's going to happen in the future, right? Slower economic activity, and vice versa, right? As interest rates roll over and start heading down, it relieves pressure in the system, and then we're going to see the leading indicators start to turn up. He also goes on to say, tracing the record back to 1885, I noted that the downturns in the laggers had consistently preceded the upturns in the leaders, while upturns in the laggers had consistently preceded downturns in the leaders. Considered on an inverted basis, the laggers were the longest of leaders. The lengths of their leads varied from one business cycle to another, but these variations were positively correlated with those in the leads of the leading indicators. Such consistency over a 50-year period bespoke a causal connection. So what he's saying is that, like I just mentioned, interest rates turn and then the leading indicators turn. Now, if we were to invert interest rates, say we invert the the 30-year mortgage rate, then it's going to act as an actual leader to the leading indicator. So let's do that. So let's take a look at that. Here we have cyclical leading index in the blue. I have just 4 leading indicators here from the housing and construction sector. These are longer leading indicators, have generally a 6 to 9 month lead time on the economy, on the coincident indicators. Okay, this consists of private residential investment, new home sales, building permits, and housing starts. Okay, and as we can see in these major inflection points, and then the 30-year mortgage rate is in orange, and it's inverted, right? So a line going down means interest rates are going up. Orange line moving up means interest rates are going down, okay? So here we can see a peak in interest rates followed by a peak in the leading index. This was around the 2001 recession. Here we have a bottom in interest rates. Well, a bottom in interest rates on an inverted basis, right? And then a bottom in the cyclical leading index. This was leading into the 2006 or 2007, 2008 financial crisis. Then we had a top in interest rates followed by a top in the leading index, bottom in interest rates followed by a bottom in the leading index. And now here more recently, we have a top in interest rates, right, on an inverted basis. So interest rates heading up, right? And then shortly after, the leading index rolls over to the downside. So as you can see, and now Jeffrey Moore's paper went from 1885 and through to 1950. As we can see, it is still holding consistent. Interest rates leading on an inverted base, leading the leading indicators. Now here we are, interest rates on an inverted basis still headed to the downside. So where do we think this leading index is going to follow? It's going to continue following to the downside. Now let's say, for instance, this was the bottom here in the leading index. Now these indicators generally have a 6 to 9 month lead time on the economy, on the coincident data. Okay, and the stock market generally bottoms in the 1 to 4 month range before the economy does, before the coincident data does. So if this was the bottom here, that means we have a 6 to 9 month time frame before the economy is going to bottom, which means there's still some more downside left in risk assets. However, interest rates are still, on an inverted basis, are still heading lower. It's going to pull this leading index down with it. Okay, so what that's saying is we have a minimum 6 to 9 month time frame before a bottom in the economy, and likely more, right? Likely a longer time frame, because this the interest rates are still heading down. It's going to pull this index down with it. Okay, so if we were looking for a bottom in the stock market, which a lot of people are trying to do right now, we're going to want to see the interest rates peak and roll over. On an inverted basis, we're going to see this line, this orange line, turn up. And then shortly after that, could be 1 month, 3 months, 6 months, the lead time varies. You're going to see the leading index, so basket leading indicators turn up. And then once they turn up meaningfully, that means we're in a 6 to 9 month time frame away from the economy bottoming, from those coincident indicators bottoming, right? The income, production, employment, consumption. Right? And stocks, they move just before the coincident data does, right? Like I said, especially when it comes to bottoms, historically in the 1 to 4 month range, you're going to see a stock market bottom before the coincident data. Okay, but as you can see, we're nowhere near that right now. Interest rates are still heading lower, which is going to pull the leading index down with it. Okay, which means, like I said, the economy is minimum 6 to 9 months away from bottoming, likely longer, which means we're not near a bottom in the stock market. Okay, there's more downside to come. Okay, so if you're a trader, investor, this is not the time to be long risk unless it's a short-term trade. Okay, it's not the time to be long risk. It's time to be defensive. It's time to be short risk. Okay. So this is how you can use, it's pretty simple, but this is how you can use interest rates to get an idea of when the economy is going to turn. And thus, that gives us a window into when the stock market is likely going to turn. In this case, we're looking for a bottom, right? As you can see, we're not near a bottom, right? But when interest rates roll over on an inverted basis, they turn up. Cyclical leading index turns up. Then we'll have our window when the economy and thus risk assets are likely to turn up, and then we can respond accordingly. Okay, I hope that makes sense. So that's really it. So if you have any questions, let me know. If you like this, please share it, like it, subscribe. Otherwise, that's it. And I will catch you in the next one.